Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics like wealth creation strategies, investment principles, creating passive income, paying off your debt faster, and much, much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I am Billy and I'm joined by my co-host,
Andrew. Hey Bills, welcome back to not only the 360 Money Matters podcast, but also back to Australia.
Andrew, thank you. And we're not meant to say that to our listeners and our viewers because the episodes and the show notes just keep rolling, right?
Exactly right. But we've had a break.
No, we were having a break, but we were working very hard.
Exactly.
Right? So
right.
let's share with our viewers and our listeners what we've been doing over the past couple of weeks.
Yeah, we were actually over in Boston. We were at Harvard Business School and getting some learnings and insights off the back of an award that we recently won. And so, yeah, that was definitely quite an experience.
Once in a lifetime opportunity, and I must say it was on my bucket list, so tick that box. Really grateful that I went, but I've got that credit card hangover. So
what do you mean? We tell our listeners all the time, you're not meant to get into credit card debt, you're not meant to have a credit card hangover, and look at you. Do as I say, not as I do, right?
That's it. We might just scrap that part from the start. What do you reckon?
Yeah, exactly.
Andrew, what are we talking to everybody about today?
Yeah, so look, today we're talking all about buying an investment property. So in this, we're assuming that you've decided that an investment property is the right thing to be going, or the right route to be going down. So we're looking at, all right, now that you've made that decision, what are some of the things that you really should be considering when you're making that decision and when you're prepping for an investment property purchase?
Yeah, and I think this is a really good one as well too, simply because that, especially in Australia, the fascination with property, and I think it still continues, but that decision now in a higher interest rate environment is much more critical, and the thinking behind it and the decisions and I'll even call it the burden associated with it is a lot greater than what it was in a lower interest rate environment. So I think this is really fitting and really timely about how does an investment property fit into your overall wealth creation strategy. So I reckon there's going to be some nuggets of gold in this one for our listeners and our viewers.
Yeah, absolutely. And you make a really good point. I mean, in an interest rate environment where, you're paying your 2% interest rate for a lot of properties, you're neutrally geared, you're positively geared from day one, and so you don't need to dip into your own pocket in order to, own a property other than just that initial deposit. And so it's a pretty easy choice, and you don't need to put much think work into it. But once times become a little bit more difficult, once there's a little bit more in there, then you really need to make a much more informed decision. And I'd argue that you need to make that irrespective of the environment, because your interest rates aren't fixed for the life of the loan, but nonetheless it's definitely at the front of your mind now rather than something that's at the back of your mind.
Absolutely. And I think the first area or the first question to solve for with this, and it's really fitting what you're saying, that it's a 30-year term. You're going to experience different cycles in terms of different property market cycles. You're going to experience different interest rate cycles. But does this fit your long-term strategy? So what does that look like? What are some of the things that we talk to people about when we're talking about considering property in terms of their portfolio, in terms of their wealth creation? Because there's definitely a place for it. Obviously, one thing that springs to mind from my perspective is diversification. Yep. So being able to have a direct asset that is property, you may be diversifying away from a share portfolio or a managed fund portfolio that you've got. So that's probably a really easy one right off the bat, getting into direct property.
Yeah, exactly right. And look, one of the benefits of property, but at the same time, one of the detriments of property is that you're in it for the long haul. And the benefits of it is it's a lot harder to make an irrational decision because you really need to think about it. You really need to put some work into selling or liquidating a property, and likewise when you're purchasing a property. But some of the detriments of it is you have to hold it for the long term, particularly when you're talking about stamp duty and the cost burden that's associated with that. That in order to make up that difference and really make it an investment vehicle that's worth your while, you have to hold it for the long term. And so making sure that it really fits into your broader strategy is of the utmost importance.
Yeah. And I think from that perspective as well too, one of the things that is obvious, but we'll call it out, and similar to what you were talking about, it's a positive and it's a negative as well too, is the ability to leverage and use borrowed money.
Yeah.
So being able to multiply, your investment, you may have your deposit of say 10% and you borrow the rest of it. It gives you the ability to get into a much more expensive asset with a smaller amount of capital to put down to start with, albeit, you've got to sign a mortgage, and we'll talk about the sleep test and stuff in a sec. But that can also work against you as well too, in an environment where maybe you buy the wrong property or you buy in the wrong cycle and the property decreases in value and you've got some negative equity. So it can also work against you as well.
Yeah, exactly right. So Billy, to fit your long-term strategy, you decided that property is what you want to go down. What's the first step?
Well, there's a first step for me before the first step.
Okay.
So I'll talk about my first step,
Yep.
and then you can talk about your first step.
Okay.
Because I did allude to it, and you didn't pick up on it about the sleep test.
Yeah, okay.
So before, and this is a really simple test that we sort of talk to clients about all the time when it comes to property, and especially in a higher interest rate environment. It's, do you feel comfortable signing on the dotted line to take a $600,000 or a $700,000 odd mortgage? How does that make you feel? Will it keep you up at night? Will it interrupt your sleep? Hence the sleep test. So I think feeling, and the reason why that's more of an issue today than it has been in the last little bit of history is because interest rates have increased, and just haven't increased per se. They've increased at the fastest rate that we've ever seen.
Yep.
So it's much more of a larger part of the conversation and a much bigger consideration than what it was traditionally in the past. So that's the first step that I tend to ask people and tend to consider is, hey, am I comfortable taking on more debt? If I am, that's okay. Then we start talking about some of these things. But if I'm not, then we need to think about something different.
Yeah, exactly right.
So the first step or the second step?
The second step.
Yeah, let's go.
So you've passed the sleep test. It's fitting your long-term strategy. I mean, goes without saying, but make sure you're getting your finances approved. Make sure you've got a pre-approval. Make sure that that's fairly rock solid. Make sure that that's up to date.
Yep.
I have seen in the past people have, gotten a pre-approval. It was 6 months ago, and they've thought, hey, a bank or a mortgage broker said that this is how much I can borrow, and they've gone and bid on a property, and all of a sudden the situation's changed. Make sure that your pre-approval is valid, and make sure that you've got finance approved before you even start looking for a property, because you also don't want to go down one route of being mentally and emotionally invested, and then realizing, hey, my borrowing capacity is not up here, it's actually down here, and I've got to adjust the type of property that you're looking for. But yeah, absolutely make sure that you've got all your finances in order.
And just a bit of a tip on that one as well too. In the event that your borrowing is up to the maximum, so your pre-approval is up to the maximum of what you can service.
Yep.
And that's what you're going in at. A pre-approval lasts for 3 months.
Yep.
The Reserve Bank, other than in January, are meeting every month. So if they're moving, it could impact your serviceability, and it could impact how much money you could borrow. So what you need to do almost is every time that the interest rate lever gets pulled and the RBA moves, you almost need to go back and have a conversation with your broker and say, and I can hear the brokers absolutely throwing daggers at me at the moment because it's going to create more work, but the truth is it could change your serviceability. It will change your serviceability. So you need to just make sure that if you are borrowing to your maximum, you're not waiting necessarily for the 90 days to redo the pre-approval to figure out what you can borrow. It could be changing month in, month out, and if you're not aware of that and you think you're okay and you borrow at what you perceive was your maximum and that's changed, you may run into a little bit of hot water when it comes time to getting all of the settlement in place.
Yeah, no, absolutely. Another really sort of big thing to consider for a lot of people is, all right, what do you do? Do you go a 10% deposit? Do you go a 20% deposit? Do you go anywhere in between? Do I pay mortgage insurance? Do I not? What's the best way to have a conversation or think about that, Bills?
I think there's really two things to consider when it comes to mortgage insurance, and traditionally, and it may have been driven by an environment where property prices weren't as expensive,
Yep.
so getting your 20% deposit wasn't as big of a consideration, or property prices weren't growing as fast as what they have of late. So paying mortgage insurance traditionally was a really big no-no, simply because it's an additional cost and you may as well continue to save and away you go. But the way that I tend to think about it is really from two things. One is from a cost perspective. So how much money will it cost you in order to pay the mortgage insurance, or how much money would it cost you in order to save up that additional deposit? And then the second thing is the time associated with it as well too. So if you've got a 15% deposit and you're trying to get to 20%, how long will it take you to save that additional 5%? Depending on your savings rate, insert number here, but if it takes an extra 6 months, if it takes an extra 12 months, what does that then mean? You're delaying the purchase for that period of time. I mean, look, not only from a time perspective, but what happens to the value of the houses in that environment as well too. So
yeah.
I don't know about you, but in my experience, when you've made the decision to purchase a property, you kind of want to move on that fairly quickly. So needing to wait any longer if it's within reach is definitely my preference, but this should be something that you talk to, your financial advisor, your mortgage broker about, and get your numbers aligned with the time, and then you should be able to make that decision based on your own preference.
Yeah, exactly. So if you're gonna, if you've only got a 10% deposit and mortgage insurance might cost you 10 grand, you may be better off paying the 10 grand and that additional mortgage or that mortgage insurance that's gonna, act as an additional cost in purchasing that asset. If it's gonna take you, a year or 2 years to purchase a property, and you estimate that property is gonna rise by more than 10 grand over that period of time, you're actually better off paying for that, getting into the property market faster and moving on, rather than trying to save that additional money. And then all of a sudden, property prices have moved more than what you would have ordinarily paid in mortgage insurance. So,
And probably the third thing is the headache of needing to sort of fight with my spouse for another year while we continue to find that property and go to open for inspections.
Yeah, exactly.
So there's the inconvenience piece as well too, right? So I don't know how you can put a dollar value on that, but it's priceless.
Well, that's going to happen either way, right? Because you're looking for the property whether you do it sooner or later.
But I'd rather it short and sharp rather than it prolonged.
Rip it off like a Band-Aid.
Rip the Band-Aid off. Absolutely. Andrew, what about ownership structures?
Yeah, look, a really, it's far more prevalent these days than sort of maybe more traditionally in the past, maybe because people are thinking about it more, acquiring more properties. But how do you actually own a property? Should you own it in a trust? Should you own it in a company? I mean, generally speaking, unless there's very specific reasons, probably not, because you do lose, that 12-month active asset test. You hold it for longer than 12 months, it gets a 50% reduction in capital gains. You lose that in a company ownership. But for most people, the consideration is, do I own a property in a trust or do I own it individually? And that will, the benefits of each will vary. I mean, if you're owning a property through a trust, generally your costs are a little bit higher in, purchasing that property and also in operating the trust that's associated with it. But the benefit is that you can start to, if you make either a capital gain or if the property is positively geared, you can distribute the profit to one particular person that's a beneficiary of that trust over another. So let's make a consideration, or let's consider that, young family made a capital gain on the property. Maybe, one of the partners is off work, either due to, having children or having a career break or whatever it is. You can distribute the profit if you've sold the property in that year to that partner and have it on their marginal tax rate, which is substantially lower than someone that's working, earning an income and paying tax. So owning through a trust is going to create more flexibility in the future, and also year on year when you're doing your tax return in that property. But it is going to increase the cost that's associated with it. So looking at not only your circumstances now, because that's usually a little bit easier for people to consider, what are your circumstances going to be in the future? Maybe you don't have a partner, maybe someone's not off work now, maybe you're both working, but it's likely to happen in the future, so let's just future-proof it and put our assets in that structure. But talk to your accountant, talk to your financial advisor, and make an informed decision around what's going to be the best ownership structure for my personal circumstances.
That's actually a really good conduit into the professionals that are involved in a property transaction.
Yeah.
So I guess from that perspective, you hit the nail on the head in terms of ownership structure, taxation advice, talk to your financial advisor, talk to your accountant. That absolutely makes sense. Buyer's advocate is a big one, which I'll get you to talk about in a sec, Andrew, but the conveyancer as well too. So the conveyancer is essentially the person that sits between settlement and the bank and you. So they help coordinate settlement and at the end of the transaction. At the start of the transaction, they read over the contract. If you're buying, they prepare the contract if you're selling, and making sure that everything's in order in terms of what's written from a legal perspective. We can understand it as a layperson, and there's nothing in there that I guess we're not unaware of, and we do go into it making an informed decision. Yep. So that's kind of how the conveyancer sits in the grand scheme of things, and they're worth their weight in absolute gold.
Yeah, exactly right. So you want to make sure you've got a conveyancer lined up, and you want to make sure that you have someone that's reviewing the contract, so that when you're purchasing a property, 60 odd pages worth of contracts, you really want to make sure that you know what you're in for, and that everything's stacks up as to how the seller is presenting that property as well.
That's it. Andrew, buyer's advocate.
Yeah, look, a buyer's advocate is another consideration for a lot of people, particularly when you're looking at investment properties. Still a consideration for owner-occupied properties, because I still argue that even if a property is owner-occupied, it still needs to have an investment lens to it, because it's going to change your equity position, it's going to change your ability to borrow in the future. But especially for an investment property, having a conversation, or at least engaging with the first steps of a buyer's advocate to understand, hey, let's put a number associated with it, I'm putting $600,000 or $700,000 towards an asset. Am I best equipped in order to be able to select the right property that's going to be at the right price and going to perform the way that I expect it to over the course of the next 5, 10, 15, 20 years that I'm going to hold it? If the answer is yes, and for some people they've got that expertise, either on their own or with some guidance from family and friends, then fantastic. You can avoid obviously the cost that's associated with a buyer's advocate. But for other people, if you don't have that expertise, making sure that you're purchasing the right property, and that it's going to grow and do what you expect it to, a buyer's advocate is going to be the facilitator to help provide some advice around selecting the right asset.
Yeah, and I always find this quite an interesting one when we are having this conversation with people. But for the majority of people, if you're fortunate enough to purchase property, maybe in your lifetime you're buying 1, 2, maybe a third property, depending on how often you're transacting and stuff. And I'd like to think that we watch The Block and we look at realestate.com and Domain and things like that. Plug if you want to sponsor us. That we all kind of have an idea around what constitutes a good property, what constitutes a bad property, what constitutes good value, what has potential, and so on and so forth. But the truth is there's so much more to it. And yes, it is a big outlay to spend that money at the start. But in terms of the difference over the life of the asset, making the right decision versus making the incorrect decision or the less optimal decision can lead to tens of thousands, if not hundreds of thousands of dollars. Yeah. And just talking about my own personal experience, I'm exactly like you. I'd be engaging with the buyer's advocate because the truth is I kind of know my stuff around property, but it's not the same as a professional who's looking at it every single day.
Yeah.
So you'd expect that the money that you're going to spend, you're going to get back in spades over time.
Yeah, exactly right. Exactly right. Another really sort of big thing that we're massive on, and that's, making sure that from a cash flow side of things, you're going to be 100% okay. And what I mean by that is, look, for a lot of people, you might consider putting an investment property on interest-only repayments because you want to pay down your principal place of residence. You don't want to pay down your investment loan, not until you've fully paid down the property that's non-tax deductible. So you might consider interest-only repayments on your investment property. And that's perfectly fine, but you need to make sure that even if that loan converts to principal and interest, you can still continue to make a repayment, you can still continue to save, you can still continue to invest, and it's not going to stranglehold you. Because you need to have some buffer room in there. In addition to that, you definitely want a buffer in case interest rates do rise. Now, we've seen that over the course of the last 12 months, and you must have been living under a rock if you haven't. But interest rates may potentially rise further, they may not, but making sure that whatever happens, I can make principal and interest repayments, I can afford interest rate rises, and I can afford a period of time, and I've got some buffer room for a period of time where the property may not be tenanted. Yes, we are seeing at the moment tenancy rates or the vacancy rates of properties is extremely low, but that's not going to be the case all the time. So you need to make sure that there's a buffer from a cash flow side of things and that you've covered all your bases there. Yeah,
and probably just a practical takeout for our listeners and our viewers. So the cash flow buffer, meaning that, you know, you've got enough liquid savings, and where you park that, you know, is the offset account potentially or a savings account, depending on what your structure is. But having enough in there that if your income decreased or went to zero, essentially converting the buffer from a dollar perspective into a time point of view.
Yep.
So as an example, if your total monthly expenses are $5,000, including everything, inclusive of your repayments, and you've got $50,000 in savings, you've got 10 months up your sleeve.
Yeah.
So picking that number as a sort of industry rule of thumb, we say between 3 and 6 months. We tend to pivot more so towards the 6 months, and I think that's a prudent thing to do, especially in a higher interest rate environment. But above and beyond that, you're also talking about, you know, factoring in additional rate increases. And, you know, if it is 10 months, you should have enough up your sleeve. But if you're closer to the 3 months, then maybe you want to say, okay, what happens if rates go up another 3 times? What does that look like? Maybe my burn rate goes from 3 months down to 2.
Yeah.
So that way could be an indication that you need to increase your buffer.
Yeah, and in addition to that, I mean, when you're owning a property, there's repairs, there's maintenance, there are things, additional expenses that can come out of the woodworks and that you don't necessarily expect. And so making sure that your buffer's in place is not only, you know, from a cash flow side of things, but also from a savings account side of things. You also need to make sure that that's there, because there are going to be additional expenses that do come up when you're owning an investment property.
Yep. Like all investing, making sure that you're not emotionally attached or emotionally invested in the asset.
And this is, I think,
this is the hardest
of all
one.
the things. This is the hardest one, especially when it comes to property. In every other asset class, I feel like people can step back and say, "Yep, it's an investment decision, and I'm treating it as that, and as long as it makes investment sense, then I'm going down that route." But property people can't seem to do it.
It's like a badge of honour, you know. I've got another property under my belt, and away you go. So it is. It's a very attractive proposition. But yeah, the best investment decisions are the ones that are made without the emotion, that they're clinical, that they're well researched. If you get emotionally involved, and that's what we see all of the time, I guess, at auctions with owner-occupier properties. You hear that the real estate agents talk about you want people that come through the property that are going to fall in love with it.
Yeah.
Because then they get emotionally attached, and that rationale goes out the window.
Yeah, and look, there is an argument when you're talking about an owner-occupied property that you may decide to bid further or pay a little bit more because it's the perfect asset and you want to, you know, facilitate a lifestyle goal. But when you're selecting an investment property, it just needs to make financial sense. It doesn't need to be in the area that you know. It doesn't need to be in the area that you live in. Doesn't need to be, doesn't need to satisfy any of your lifestyle considerations. You just need to make sure that it makes financial sense, that it's going to, provide the capital growth, provide the income that you want it to, in order to, help meet your financial goals, because this is a financial decision. It's not a lifestyle choice. And that can sometimes be very hard to differentiate, particularly when you're talking about property.
And then probably just rounding this out, Andrew, last thing that we tend to think of, I mean, we obviously spoke about the buffers and being able to withstand economic shocks. Risk mitigation strategies, so making sure that you've got your insurances in place.
Yep.
I guess that's the broad range, and probably extended a little bit further than the personal insurances that we talk about, but also having, your home insurance in case a tree falls down on top of it, or your contents insurance to make sure that in case the house gets robbed.
Yep.
And then your personal insurance along the side in case anything happens to you as well.
Yeah, exactly right. Making sure that there's a risk mitigation in place, overlaying that with, your cash reserves and your cash buffers as well, and making sure that, if things don't work out the way that's expected and things that are out of my control tend to happen, then you want to make sure that that there's something there that's also going to provide you some comfort and a bit of support as well.
Andrew, well said, well summarised. I reckon there was a fair bit in that, and I reckon there was some nuggets of gold.
Yeah, no, absolutely. It was good to jump back on the podcast again. It's just like riding a bike. You definitely don't lose it.
Well, we hope so anyway. We'll wait and see. So to our listeners and our viewers, thank you once again for your time. Like and subscribe as always. Tell your family and friends about us because we'd love to get the word out. And we'll catch you on the next one.
Thanks very much and look forward to seeing you on the next one.
Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and it is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amiridis and Andrew Nicolaou of 360 Financial Strategists Pty Ltd, authorized representatives and credit representatives of AMP Financial Planning.